Okay, good. Please, you are welcome. You are welcome to today's session of IPSAS Masterclass, day 2. Very well, good. So the other day, we began with the initial measurement, okay? The initial measurement. And we all understood that initial measurement should always be done using the cost method. With the initial measurement, you should always consider all costs incurred in bringing the asset to its current use. I believe you understand it. All costs. So with the initial measurement, you only consider all the costs you have incurred. All costs. All costs. To bring the assets working condition. All costs. If you want to write the cost of the asset, you have to use all costs. You have to use all costs that you have incurred to bring the asset to its current working condition. That is initial measurement. That is the initial measurement. Are you okay? All cost. It may be site, maybe installation, any cost. Are you okay? Cost of delivering the assets, any cost. But we have certain key costs you don't include. In the initial measurement, you have certain costs you don't include. Very practical, very practical. If a company buys any assets, make sure the first cost you measure in your book is the cost that the practical. Very practical. Very practical. Very well. Good. So we have an example which we were supposed to look at, but because of what happened, we couldn't look at it. So quickly, let us go to this question. So it says that what? S&D Professional Institute started construction on a building for its own use on 1st April 2017 and incurred the following cost. Purchase of land. Like we said, if you want to, so they want you to determine the cost that should be recorded in the books. The cost that should be recorded in the books for the year ended. The cost that should be recorded in the books. That's what they want you to find. So you know that if you are measuring the initial, you are measuring the cost of an asset, and that cost of the asset is the initial cost, or is the first time you are recording it. If a company buys an asset, this question is a building, and this is the very first time you are recording it. If it is the very first time you are recording it, you have to record the cost at which you bought the asset, plus any other cost related to getting the asset for use. You understand it? So since it is a building, you and I know that with a building, you obviously have to know the cost of the land the building is sitting. So therefore, you consider what? The land, purchase of land, the land cost. In order for us to know the building cost, you have to consider the land cost. We also have something called stamp duty. You understand it? Stamp duty. Maybe registering the land and other things, no, they pay certain stamp duty. So this too is a cost of what? The building. Even though stamp duty is not a building, but it is also part of the cost to get the building ready for use. So therefore, you have to include stamp duty. Legal fees. Look at something. I want cost of building, but why are we considering legal fees? Legal fees because it is also part of the cost that will be incurred in getting the building ready for use. So legal fees too will be what? Will be included. Site preparation and clearance. The cost of preparing the land and clearing the land should also be considered. Can you see that? The cost of clearing and preparing the land should also be considered. You understand it? So these two will be part of the what? Of the cost of the building. Can you see that? Because this is the initial cost. The first time they did, all costs involved. So if a company builds a factory and you, the accountant, you're expected to record the cost of the factory in your books. You don't just ask them, how much is the factory costing? You start from the beginning. I tell them that they should give you all costs related to putting up the factory, including clearing the land. Maybe they cleared, or including weeding, the weeding boys, the boys that came to weed the land. How much did you pay them? That too should be part of the cost of the factory. Are you okay? Cost beer. That's why we are including legal fees, stamp duty, because they incurred all these expenses in order to get a building ready. Any cost beer. Then go to materials. The material they used. This too is a cost of the building. In order for us to get a building ready, we bought materials. We have labor. You get it? Labor. Labor too is part of the cost. Do you know labor? Workmanship, right? So workmanship too should be part of the cost of what? The building, because the people, the mason and the whoever, all those people that we employed to build it, they are all part, okay? Architect fees, the person who drew the plan, the architect, this is a professional charge. Architect fees is a professional charge. You understand it? That too should be part of the cost. Any cost that was involved in getting the building ready for use should be included. They have general overhead. General overhead means that what? General expense. And that can be administrative expenditure. Can you see that? So because it is general, whether we built the factory or not, we would have incurred it anyways. General overhead. We didn't incur this expenditure because of what? Of the building. No. It is general. Whether we built the factory or not, we would have incurred it. So anytime you see something like general overhead, general something, be attentive to it. Okay. Do you know this question came in ICA 2025 March? PSA. Do you know this question came? Yes, this question came. ICA March 2025. This question came. So if you understand it, no matter how they frame the question, you should be able to do something about it. Are you okay? So general overhead, you not include it because this is what? An administrative charge. Are you okay? Whether it's something like electricity, whether you build it or you don't build, you still buy electricity. So electricity shouldn't be part of the cost of the building. Can you see that? By expenses you incurred specifically because of the building, those are the charges you have to include, with the exception of those I've mentioned above. Are you okay? Let's proceed. The following information are also what? Relevant. One, material costs were greater than anticipated. It means that the material cost here is greater than we budgeted for. The material cost is so much. We didn't budget this much. So what was the reason for which the material cost was so much? This is grammar. Material costs were greater than anticipated. On investigation, it was found that materials costing 10 million had been spoiled. Can you see that? It has been spoiled though, and you and I know that you don't include any abnormal cost. You don't include any spoilage, material losses. You don't include it because ideally, these materials were not supposed to spoil. It is out of your own carelessness. That's why they got spoiled. So if the material spoil, don't include it as part of the cost of the assets. Babi, ideally, they were not supposed to spoil. So on investigation, it was found out that materials costing 10 million had been spoiled and therefore wasted. I see that wasted cost should not be included. It was not supposed to be wasted. It is out of your own carelessness. When materials spoil, don't include it as part of the cost. So it means that this 100,000 you are seeing here, 10 million has spoiled. 10 million has what? Spoiled. Can you see that? Okay, this is already in 30, so 10 million So let me, it will be 10,000 has sports. So I'll subtract 10,000 from it. This 100,000 you're seeing here, I'll subtract 10,000 from it. Continue. He says that what? A further 50 million was incurred on materials as a result of 40 design. You have gone to draw a 40 design. Please, all these things, no, is not supposed to be included in the cost of the assets. Can you see that? They said operating losses. In the cost of building, in the cost of doing any losses, don't include it as part of the cost. So 40 design to is 15 million. So you subtract another 15 million from it. So you see, so these ones, no, we are not going to include it. Perfect. Let's proceed. Let's go to the footnote 2. It says that as a result of these problems, work on the building ceased for a fortnight during October. Okay, the work ceased for 2 weeks. Fortnight means 2 weeks during October 2017. And it is estimated that approximately 9 million of the labor cost relate to this period. You see that 9 million of labor cost. So work ceased. And they are saying that when work ceased, 9 million of labor cost relate to the period that work ceased. So if work ceased, it means that the labor will not be working. You understand? Labor will not be working. And how much did we pay the labor when they were not working? We paid them 9 million when they were not working. So it means that the labor cost here, 150 million, 9 million is supposed to be subtracted because they didn't work for that amount. Can you see that? So this 150, you have to subtract 9 million because during this time they didn't work. So you don't have to add it to the cost of the asset. Rather, this 9 million, you treat it as an expenditure. In the statement of financial performance, write it off as an expense. You should not treat it as part of the cost of the asset because during this period, they didn't do anything in relation to the building. They were not working for the building. So that amount should not be included as part of the cost of the building. Can you see that? They didn't work on the asset. So don't add it to the cost of the asset. The 9 million should be subtracted and rather treated as an expenditure in the statement of financial performance. Perfect. The last one, the building was completed on 1st July 2018 and occupied on 1st September 2018. So please, the long and short of everything I've done is that you don't include operating losses. Don't include operating losses when you want to find the cost of the assets. So if your company buys a new car and they tell you that the cost of the car is 5 million or 5,000, the cost of the car is 5,000. Car to bring the new car to the factory. The towing car took 200 cedis. And they hired a specialist, a car specialist. Okay, a car specialist to ensure that everything is specialist also took 50 cedis. And boss calls you and tells you that if the cost of the car we bought, record it in our books. Please, you are a chartered accountant. If you receive the 5,000, ask your boss, please, apart from this 5,000, did you incur any cost because of the car? Ask about this question. Boss, did you incur any other cost because of the car? Your boss will say, yes. Oh, we hired a specialist to ensure that everything is okay. We paid him 50 cities. So you have to add the 50 cities to the cost of the car. 200 cities, a towing car to bring the car to the factory. Do you understand it? This is what I'm trying to establish. The line is breaking again. This is your MTN people. So please, the basis I'm trying to establish is that you have to include specialists. When he came, Instead of working on the car, he rather came to work on the machine of the factory, meaning that he didn't work on the car specifically. When the specialist came, instead of working on the, he rather went to work on a different machine, not on the car. So therefore, if you want to find the cost of the car, don't include the 50 cedis, but rather take only these two because he didn't work on the car. Please don't understand it. It's like if your company says that, oh, we bought raw material 50,000, and out of the 50,000, 5,000 got spoiled. If you want to find the cost of the asset, don't include the part that got spoiled. So it's as simple as that. Can you see that? Please, I'm sharing the screen. So please, if the initial cost includes all costs to bring the asset to its present condition, with the exception of the cost I mentioned, the key of them is the what? When operating losses, okay? Or when the asset, some of the material gets spoiled. Okay, so quickly, given this question, if you want to find the cost to record in our books, if you want to find the cost to record in our books, it's simple, very simple, okay? So S&D, in the books of S&D, okay? Building cost. So in my books, okay, statement of financial position. So building cost, I have to write a building cost here, but let me show workings. Workings. So the cost of the building will be okay. It is in dollars. So it's in dollars. So I have land 250,000. Have stamp duty 5,000. Legal fees, all these are cost incurred to bring the building to its current condition. We have site preparation. Site preparation, 18,000. We have materials, 100,000. That the question says that materials were greater than anticipated. On investigation, it was found that materials costing 10 million had been spoiled. So in fact, so the materials, no, I will not write the entire 100 million, but rather I will show working. Is that also? So it will be the 100 million minus 10. In fact, everything is in thousand. Can I say that? Then 15. So I'll get what? 75. Perfect. Can you see that? Because they said 50 million was lost due to what? Faulty design, and what? 10 million was spoiled. 10 million too was spoiled. Is that also? That is so. So let's proceed. Labor. So the labor, they said that the labor hours, no, they didn't work throughout. They didn't work throughout. There was a break for 2 weeks. Fortnight means 2 weeks. And the cost for the break, no, if the labor had worked throughout, from the beginning to the end, the entire 150,000 would have been added to the cost. But they said that there was a break, and because of that, the labor did not work for 9 million. So therefore, the 150,000 minus the 9 million that the labor did not work for the building. They worked elsewhere. They didn't work on the building. So when it's subtract this, you get what? 141,000. Is that also good? Then we have the next one, architect fees. 20,000. So in all, you have total. Please, what's the total? Chat box, please. Or you can raise your hand and give me an answer, please. Who has the total? 500 and or 51,000. No, 519,000. That is 519 million. Please confirm. Is it correct? Is it correct, please? It should be correct. Confirmed. Perfect. Good. Thank you, madam. So the building cost will be 519,000. So this will be the cost, the initial cost. So now we have the cost of the building to be 519. Is that also? We have the building cost to be 519,000. Yes. You have the building cost to be 519,000. It's in dollars. This is the building cost. This is initial measurement. Initial measurement. So initial measurement, this is how you measure it. Are you okay? So initial measurement, no, all costs related to bring the asset to its current use or its current condition. All costs, with the exception of operating losses, cost of commissioning, but the key is operating losses. Are you okay? Perfect. All costs. Assuming the question, sometimes they give the question. It's as simple like this. Simple like this. Sometimes I do not tell you there was a wastage. They'll just mention all of them, and you have to know the operating losses. If they say that they incurred an operating loss, don't include it. Are you okay? They incurred an operating loss. They incurred an administrative loss. As you can see, we didn't include the administrative loss. Can you see that? We didn't include the administrative loss. See, general overhead. With or without a building, they would have incurred this cost. So we didn't include it because it's not really necessary. Without the building, they would have incurred it. We only include costs that are incurred because of the building, with the exception of what? With the exception of commissioning, cost of commissioning, interest on deferred payments, training cost, except when the training cannot be separated from the cost of the asset, then general administrative expenses. Thank you very much. This is initial measurement. Usually, the question will not give you a question. In fact, usually, okay, examining bodies will not give you initial measurement, but practically, you will find initial measurement everywhere you go. Practically, because our companies do build. The companies we work in, they do buy assets from time to time. So you'll be there and your company will go and buy a computer. Your company will go and buy a computer. The computer costs 20,000. And you record only 20,000 as a cost of the computer. That's wrong. You have to ask them the TNT to go and buy the computer. It is if they went to the market solely to go and buy the computer, then you have to include the TNT to the cost of the computer. You understand it? Yes, you have to add the cost of the TNT delivery. If it was okay, any cost related to get it. So that is how you do it. But some of the costs, they are too small that you tend to expense it or write it off. It is okay to do that. Thank you very, very much. So please, from here, go and try more questions on what? Initial measurements. Initial measurements. Move on to the next question. Or move on to the next. So we are done with the initial measurement. Are you okay? We now go to the next subtopic, which is what? Please, what if? So Faraday, please, if I had your name wrong, forgive me. Our sister is asking, sir, please, what if the losses are as a result of natural disaster? If they are out of a result of natural disaster, why should you include it to the cost? Brofo, please do not include. If it is out of a natural disaster, you treat it as an normal expenditure. Are you okay? Treat it as an expenditure. Write it off. Don't include it to the cost of the assets. It's as simple as that. Okay, don't include it to the cost of the assets. No, they say don't include any cost, any loss. Are you okay? Whether natural disaster or intentional, don't include it. Are you okay? Thank you so much. So let's proceed. In fact, some of you have to respect too. Respect. Just respect. Respect.
Sir. Hello, sir.
Who is this? Yes, please.
Sir,
Please, if you want
please,
to ask a question, raise your hand.
sir, my hand is up, but
okay, please ask. Ask.
My question is that yesterday, the example that you gave first, like if the assets will be, the machine bought will be depreciated or will stay for
Yes.
50 years
Yes, it's
or
on
10 years, how are we going to treat it? So, sir, in that case, are we going to calculate only the percentage used for the period, or you will bulk the cost and then you'll be depreciating it small?
The ideal thing to do, how we wish you could have done it that way, for us to know the percentage of the machine that was used to produce the goods. How we wish you could have done it that way. But you and I know it's not possible. It's not possible for us to know the quantum of machine we used to produce the goods. Hence, the company has to decide on a policy to use. Are we using straight line method or reducing balance? Madam, please, do you get it?
Yes, sir.
Just that the question you're asking now is not on initial measurement. We will come to that. Ask me that question later, okay?
All right, sir.
Ask me that
Thank
question.
you.
Very well.
All right.
Good, you are welcome. Please. So for the initial measurement, there's nothing difficult about it. Nothing difficult. Nothing. All costs incurred to get the assets ready. So just add the cost, and you are good to go. Perfect. We move on to the next one, which is what? Subsequent measurements. Now, we have recorded the cost of the asset in our books. So in this case, now, what is the cost of the building? 519,000. That's the cost of the building in our books. You see, now we have the cost in the building in our books now. So after 1 year, so let me explain it to you. So you see, at the beginning of the year, we have the cost in our books like this. So the cost, using the cost method, okay? Using a cost method. So I've recorded the cost in my books like this. So did the cost. You see, we have something called initial measurement. Initial measurement is when you buy the asset fresh, or when you build the asset fresh. The first amount you write in your book is the initial measurement. That's initial. The first amount you write in your book, or the first measurement. Then after that, the year after. So in the year 2017, the cost in my book building is 519,000. This is the cost in my book. In my book. Do you get it? So we have something called subsequent measurement after, let's say, 1 year. Okay. After 1 year, it's no more initial. It's now called subsequent measurement. After you have recorded the cost in your book, we now move on to the next level, which is called subsequent measurement. So the first time I was recording it, you have an initial measurement. After the first time I've recorded it, a year later, I now move into subsequent measurement. And with the subsequent measurement, there are two methods that I can choose from. With a subsequent measurement, we have something called Say subsequently. So initial measurement, I'm done. Subsequently, how do you measure it? Subsequently, how do you measure it? How do you measure it? That's what we call the subsequent measurement. Subsequently, how do you measure it? So subsequently, there are two ways I can measure it. I can use the cost model or the revaluation model. Subsequently, that's the word. Subsequent measurement. Subsequently, I can use the cost model or the revaluation model. Are you okay? So subsequent measurement, I have two choices I can choose. I can decide to use the cost model or the what? The revaluation model. Now, the cost model is the easiest. The cost model is the easiest. So the cost model basically says that you see the cost I have in my book. This cost I have in my book. The cost of the building I have in my book. Don't do anything to it. The cost should be there. Don't do anything to the historical cost. The only thing you have to do is to what? Calculate depreciation. Like you have been doing. If you have ever prepared financial statements, the method you are likely to use is the cost model. Okay, so just calculate depreciation on the building. That's the cost model. So every year, calculate depreciation. So the cost you have in your book, maintain the cost. Then every year, they'll be calculating depreciation. Every year, be calculating depreciation. Every year, be calculating depreciation. Every year, be calculating depreciation. That is the what? The subsequent measurement. Initially, in the year, I've already recorded. I know the cost of the assets. After a year, now we move into subsequent measurements, right? So subsequent measurements, no, I can decide to choose the cost model. So the cost model says that is the cost of the asset less depreciation or impairment. So please, so let's say the company decides to depreciate the asset by 10 years. The company decides to depreciate the asset by 10 years. So depreciation will just be, so depreciation will be equal to this amount, 519,000 divided by 10. So therefore I'll get 51900. Can you see that? So this will be the depreciation. This will be the depreciation. Say depreciation, then we all understand. And I said, this building, you know, I built the building to produce goods and services. Okay. So therefore, the cost of the building, I have to share it on all the goods I'll produce. I have to share the cost of the building on all the goods. So you have to ask yourself, how many years will I use the building? So in this question, I'm saying that I'll use the building for 10 years. So it means that I'll be depreciating the building for 10 years. So after I depreciate it, so it is this amount divided by 10. So this is the amount. Can you see that? This is the depreciable amount. So this amount, you know, the cost model says that it is the cost less depreciation. That's the cost model. So the carrying value means the net book value, the value at the end of the year. Carrying value, okay, means the value at the end of the year or the net book value is the same thing. At the end of the year, the value will no more be 519. No. At the end of the year, this value has to reduce. It has to reduce by the depreciation amount. So you subtract depreciation from this. So it is equal to 519,000 minus 51900. Can you see that? This will be the net book value or the carrying what value. What you here? Into cost model, they say just subtract depreciation from it. Just subtract depreciation from it. That's all. Don't do anything to it. Just subtract depreciation. This is for babies. The cost model is for babies. Okay. Please, I said something. I said carrying value. I said carrying value or net book value. Okay. The value at the end of the year, after you subtract depreciation, is what we call the carrying value or net book value. In fact, stop saying net book value and use carrying value. They are the same. Are you okay? So at the beginning of the year, the cost of the asset was 519. And I have used the building to produce goods. So I have used the building for the year. So at the end of the year, you calculate depreciation. So you say less depreciation. So the building will no more be 519. You calculate depreciation. Then the value you get is what you call the carrying value, or net book value is the same. So this is cost model. Cost model says that subtract depreciation from the cost. Subtract depreciation from the cost. Can you see that? So you have to know the depreciation. So the question will tell you. So this question, I said, the asset is depreciated by 10 years. I said the asset is depreciated by 10 years. So 519,000 divided by 10. It means I'll be using the asset for 10 years. So you get 51900. You see, I'm a smart guy, I'm a sharp guy. I calculated the thing without looking on a calculator. Me now calculated it. 51900. So when you subtract it, please, how do you get? Mr. How do you get? How much do you get? It's not a time for you to prove you're also a smart guy. How much do you get? You get 467,100. So this is now the value of the assets at the end of the year. What does it mean? What it means is that I have used the asset 51900. This is how much I have used the asset in a year. I've used this much of the assets in a year. In the year, no, this is how much I use the assets. Depreciation simply means the value of the assets I have used in the current year. The value of the assets I have used in the current year. It's as simple as that. So if I produce goods, not just say sets, no, I use 51,900 in a year. And our sister asked a question which I told her that it is not on initial measurement, but rather it is on subsequent measurements. So my sister, you were saying that, say, so will it be possible? I mean, you asked a question that, are we supposed to calculate the value? Madam, ask your question again, in order for me to get it clear. So your question that you asked was on subsequent measurements. We wish we could know exact amount of the building we used in a year. But it's not possible for us to know the exact amount of building we used in the production process. It's not possible. How do you know that we used 50,000 of building? It's not possible. So therefore, the company has to make a decision as to whether they are using the reducing balance of depreciation or they're using the straight line method. If they're using reducing balance, then the balance will be at the initial stages, depreciation will be so much. Then as time goes on, depreciation will be reducing. Depreciation will be reducing because the assumption is that. Let me tell you the assumption behind the reducing balance. What's the reducing balance? No, it means that the depreciation will not be charged uniformly. At the initial stages, to charge huge depreciation. Let's say year one. If you are using reducing balance, year one, we will charge depreciation of, like, let's say, 51,900. Year two, we will not charge 51,900. We will charge around 40. We will charge depreciation of, let's say, 30,000. Year four, we will charge depreciation of 15,000. That is, if you're using reducing balance, it will not be the same throughout. Why? Because the assumption is that if you buy the asset fresh, you buy the asset new one, new you'll be able to use the asset. You enjoy using the asset. The efficiency of the asset will be very high. You understand? You use the asset more if it is fresh. The efficiency will be very high. It will not spoil for you to repair and others. So therefore, let's charge and it means you will not be able to use the car for that period. So therefore, reducing balance is that as time goes on, then we will be reducing the depreciation. As time goes on, we will be reducing the depreciation. You get it? Because if it is the asset is new, the efficiency is very high. But then as time goes on, the efficiency will be reducing. So as the asset is new, then the depreciation should be high. But straight line method says no. Straight line method says no. Let us divide the total value of the assets by the total useful life of the assets. So if you have to use the asset for 10 years, let's divide it by 10 years, such that year one will be 51,900, year two will be 51,900, year three will be 51,900. Straight line here, just a straight line. In exams, usually, you use straight line method. Practically, most companies use the straight line method because it's the easiest of all. In exams, mostly, you use the straight line method, especially PSA. PSA, you will be using straight line method a lot. But in financial reporting, once a while, they can ask you to use the reducing balance. Are you okay? Very well, very well, very well. So that's just on depreciation. Are you okay? The depreciation method you employ. So depreciation simply means the value of the asset you have used. The value of the asset you have used. That's what depreciation simply means. Are you okay? The value of the asset. If you don't do it that way, then it means you are going to undervalue your asset. Sorry, you are going to undervalue your product. You are going to undervalue your product. Can you see that? Perfect. So that's the meaning of depreciation. So this is the cost method. Basically, this is the cost method. The cost of the building less depreciation. That is the what? The cost method. Can you see that? That subsequent measurement.
So we can't hear you.
It's gone. Okay, welcome back. Welcome back. So we are done with the cost model. Please, you are to choose one. Oh. It's not that you have to use the two. Dabi. Use one.
Yeah, the line is breaking.
Is it still breaking? 1 second, please. So you are supposed to choose one between the cost model and the revaluation model. You are supposed to choose one. Are you okay? Perfect. So the revaluation model, like the name suggests, table 4, revalue, that's the name. The revaluation model, okay? The name is what? Revalue. The name is what? Revalue. So the name is revaluation. Revaluation. It means that what? They have revalued the assets. Table 4. They have what? Revalued the assets. So let me give you a scenario. In 2021, I received a call from my friend, Felix. He told me, Steve, Charlie, I'm short of cash. I really need cash to do something. So because of that, I want to put out my vehicle for sale. Because Felix was my friend. I asked him, Felix, how much do you need? He said, oh, I need 15,000. Because of that, I'm selling my vehicle for 18,000. Hey, I thought the vehicle was faulty, not knowing that there was nothing wrong with the vehicle. Neat vehicle. He was selling it for 18,000. He said, well, because you're my friend, so you just bring 18,000 and I'll give it to you. So I gave Felix the 18,000 and Felix gave me the vehicle, 18,000. So in my books, how much did I buy the vehicle? 18,000. So in my book, no, the cost of the vehicle is 18,000. Cost 18,000, no. That same vehicle is being sold for 75,000. That same vehicle, and today, because of inflation and what have you, you see, as of 2021, 18,000 was substantial money, but today it's not substantial money, right? That same vehicle, I'm talking to you based on fact. That same vehicle is being sold for 75,000. Hey, the same vehicle. So the question I'm asking you is that, will it be appropriate for me to have the cost of the vehicle to be 18,000 in my book? Or I should change this from 18 to 75,000? Because I bought it at 18,000 and I'm using the cost model. The cost model is the historical cost that you bought the vehicle is what is supposed to be in your book. If I use the cost model, the historical cost at which you bought the vehicle is what is supposed to be in your book. Then every year subtract depreciation. Every year subtract depreciation. But today, the cost of the vehicle is not the same vehicle at that same condition. It's not, if I'm to sell the vehicle today, that vehicle, if I'm to sell it today, I'll get 75,000. That's the fair value of the vehicle. How much I'll get if I'm to sell it today. I bought my vehicle in 2021. It's 18,000. Every year, I subtract depreciation. Every year, I subtract depreciation. Today, 2025, if I'm to sell the vehicle, I will sell it for 75,000 at that same condition. But to begin with, how much will, please, so I want to ask a question, okay? How much will the cost of the vehicle be in my books today? Will it still be 18,000? The vehicle I bought from Felix at 18,000, okay? Every year, I subtract depreciation. Every year, I subtract depreciation. How much will the cost of the vehicle be in my books today? Will it be the same 18,000 or less than 18,000? Mana Rosina, unmute yourself. Will it be 18,000 or less than 18,000? The car I bought from.
It will be less than 18,000 because of the depreciation you'll be charging every year. If it is on straight line method, it will be
because of the depreciation. So I have to subtract the portion of the vehicle I used. That's the meaning of depreciation, right? Every year I use the car. Every year I use the car. So the cost of the car I use, no, subtract it from the total cost. Is that also good? So let's make it interesting. So let's say depreciation is 10%. Okay. Or let me say, when I bought the car in 2021, the plan is to use the car for 10 years, 1 year. So depreciation will be divided by 10. 1,800. So every year, this will be the depreciation. Okay. So in 2021, I bought a car 18,000. So depreciation for 2021 will be 1,800. Is that also 2021 depreciation? No, 2022. So 2021, I'll get a net carrying value. So carrying value. $18,000 minus 1,800. Is that also 16,200? So 2022 Still, the cost was the cost there doesn't change. The cost is still 18,000, right? But the depreciation this time around is going to be depreciation will be 18,000 for 2021, 18,000 for 2022. So two depreciation. 2021 then I'm used to, and 2022 then I'm used to, and that will help you to get a true cost. So we call this one accumulated depreciation. The previous year depreciation and now old depreciation in here, accumulated depreciation. What I say? Old depreciation, we call them accumulated depreciation. So in 2023, the cost 18,000, right? So I have accumulated depreciation. Depreciation, this old two depreciations, they are accumulated depreciation, right? Old depreciation that has already been deducted. So the two will be 3600, right? This is accumulated depreciation. Less depreciation for the year. 1800. This depreciation for the year. One, 2, 600. Let's go. 2024. The cost of the car I bought was 18,000. I'll teach you something else. I just want you to get a concept, okay? Then the past depreciation, depreciation for 2021 and 2022 is here. Then depreciation for 2023. So the total depreciation so far is 1800 times 3. Is that also? So that's what called the accumulated depreciation that has already accumulated in previous years. Brofo, depreciation that has accumulated in the previous years. So on your trial balance, you always see accumulated depreciation. And you always subtract accumulated depreciation. It means depreciation that has accumulated for previous years. So we have depreciation for the year. This is the depreciation for the year. 1,800. So you subtract this one too. So subtract this and this from this. 18,000 minus 5400 minus 1800. What do you get? You get 10,800. Then 2025 is when I decided to revalue the assets. So as at 2025, the carrying value, this is the carrying value of the assets. The carrying value or the net book value is no more 18,000. So at the time I want to revalue, the asset is now costing 10,800. It's no more the 18,000 asset I bought. Because when I bought it 4 years ago, I bought it at 18,000. 4 years ago, I bought it at 18,000. In today, 2024, sorry, January 2025, it will no more be 18,000 because 18,000, I use the asset in 2021, I use the asset in 2022, I use the asset in 2023. So you have to be subtracting depreciation. Depreciation simply means the value that you used in the year under review. Are you okay? So this thing I've done, the long and short of it is that if I'm in 2025 and I want to know the value of the asset in 2025, you don't worry, we'll come there. I think we'll come there. Don't worry, we'll come there. Okay. So let me explain what I've done. This is what I've done. Okay. Now I bought the asset in 2021 for 18,000. Okay. Then every year, you and I know that you have to depreciate the assets. Is that also? But then the question says that the asset will be used for 10 years. So you divide it by 10. So every year, this will be the depreciation for every year. So in 2021, okay, you will subtract 1,800 from the cost. This is what you've gotten. In the year 2022, you subtract another 18,000 or 1,800 from the remaining balance. This is the remaining balance, 16,200. So minus 1,800. You get this. Or if you like, it will be 18,000 minus the first depreciation and the second depreciation. Then the third year, it is 18,000 minus all the depreciation so far. Accumulated depreciation, 1,800 times 2, then depreciation, 1,800. So you get this. Then the year 2024, how many times have I subtracted depreciation? 3 times already before the depreciation for the year. Are you okay? Perfect. So in the long and short of it is that if you are given a question, you understand it, and want to find the carrying value, you want to find the carrying value of the assets. It's simple. So carrying value So carrying value is cost minus total depreciation till date. Please, total depreciation till date means that from the time I bought the asset, the year I used the asset in year 1, the depreciation for that year 1. I used the asset in year 2, the depreciation for year 2. I used the asset in year 3, the depreciation for year 3. I used the asset in year 4, the depreciation for year 4. So total depreciation for the year. A key word is total depreciation. So the cost that you bought the assets minus total depreciation. So in this question, I'm in 2025, January 1st. I mean, the scenario I gave you about Felix. I'm in 2025, and I want to know the value of the asset as at 2025, January 2025, the value of the asset as at January 2025. So if I bought the assets in 2021, January 2021, the asset was bought in January 2021. Can you see that? Then it means that I will use the assets from January to December of 2021. Okay, so I'll use the asset in 2021 because I didn't buy the asset on December 2021. I bought it on what? January 2021. So January to December is 1 year. Then I'll use the asset in 2022, January to December of 2022. Then I'll use the asset in 2023, January to December of 2023. I'll use the asset in 2024, January to December of 2024. And I want to do the revaluation in what? January 2025. It means that for 1st January 2025, I've not used the asset yet. I've not used the asset yet in 2025. I'm about to begin 2025 usage. Are you okay? So how many years did I use the asset? I used the asset for 4 years. I used the asset for 4 years. In order for me to find the carrying value, is the cost minus the total depreciation till that time. Total depreciation. So therefore, the cost is equal to 18,000. That's how much I bought it. Okay. Less depreciation. So depreciation will be the 1,800 times 4. So I only say depreciation was 1,800, right? 18 divided by 10. 18,000 divided by 10 is equal to 1,800. How many times or how many years did I use the asset? I used it 1, 2, 3, 4. So total depreciation, like I said, is what? Please, 1,800 times 4. Total depreciation is 7,200. So total depreciation will be 18,000 minus 7,200. Answer is what? 10. So as at January 1st, 2025, or as at 31st December 2024, this is the carrying value or net book value of the assets. Simple. So all what I was saying is that in order for you to know the value of the assets at a point in time, just know the cost of the assets and subtract all depreciation from the time you started using the assets to the time you are talking about. You have to know the cost of the assets. Subtract all depreciation from the time you started using the assets till that time you are talking about. So let's take this question. Example 1. Look at this. S&D Professional Institute bought an item of property, plant, and equipment for 80 million on 1st January 2012. So cost is 80 million. Cost is 80 million. On the day that you bought the assets, the day, why would they give you this date? For you to know when they started using the assets, in order for you to know the total number of years they have used the assets. 2012. Can you see that? Date. Perfect. The asset had 0 residual value and was depreciated over its useful life of 20 years. They are going to depreciate the asset for 20 years, say 20 years. On 1st January 2015, the asset was revalued. On 1st January 2015, the asset was revalued. So they are saying that what? On 1st January 2015, the asset was what? Revalued. They revalued it. What do they mean? What they mean is that the value in the book was changed. Okay, the value in the book was changed. Like in my case, that I bought the car for 18,000, but in 2025, the value is now 75,000. So I have to change the value from 18,000 to 75,000 because there has been revaluation. If you want to use the revaluation method, then you have to go to the market. Listen, if you want to use the revaluation market, at the end of every year or at the beginning of every year, you have to go to the market. Then you have to go and ask the market folks how much they are willing to buy your assets. This same asset, you send it to the market and you ask them, how much are you willing to buy these assets? The price they will give you is what we call the revalued amount. So the price they will give you, go into your company, then go and change the price you have in your books into that particular price. That's why we call it revalue. So under revaluation, you see, you will already be having an amount in your books. So like my car, okay, I bought it at 18,000. I depreciated it for 4 years. So at the end of 2024, the value was 10,800. This was the value in my books. But if I'm using revaluation method, we have to go to the market and ask the market folks how much they are willing to buy that same car. If they tell me that, oh, this car, you will buy it for 75,000. If they will buy it for 75,000, it means that the 10,000 come and cancel this amount from my books, then write 75,000 there. Yes, so the value in my books will now become 75,000. The value in my book will now become 75,000 and no more 10,000. Why? Because I have used revaluation. So revaluation gives you the liberty for you to change the value in your books to the current market price. What I say, change the value you have in your books to the current market price. That's what we call the revaluation. You have to revalue the price you have in your book. You have to revalue. So to revalue, change the price you currently have in your book to the current market price. Change the price you have in your book to the current market price. Are you okay? So in order for you to solve a question on revaluation method, you always have to find the current market. You have to find the current value of the assets. You always have to find the current value of the assets. Like when I mentioned my car incident. So my car, now I said I bought it in 2021. And I'm now in 2025. How much is the value of my car now? You first of all have to know the value of my car before you can continue to do the revaluation. So always, you have to know the current value of the assets. That one is up to you to find it. No question will solve that one for you. So always be prepared to, first of all, one, find the current value of the asset in question. Before two, proceed to calculate the what? Revaluation. Two, you calculate revaluation surplus or revaluation loss. So this is what you always do. Always, you have to find the current value. So this question says that, oh, an asset was bought in 2012 for 80 million. You understand it? And the asset is supposed to be used for 20 years. The asset is supposed to be used for 20 years. That's what the question is saying. On 1st January 2012, 2015, the asset was revalued. So they revalued the assets in what? 1st January 2015. That's when they revalued the assets. So how many years have they used the assets? Before 1st January 2015, how many years have they used the assets? You have to find it. Are you okay? So if the cost of the asset is 80 million and the useful life is 20 years, how much is depreciation per year? How much is depreciation per year? And how many years have they used the assets as at 1st January 2015? So let's do it together. So depreciation, which is so easy for all of us to find, depreciation will be equal to 80 million divided by 20 years. Is that also? So you get, please, how much will you get? 80 million divided by 20 years. You get 4 million. Right? You get 4 million. So how many years did they use the asset? The asset was bought on 1st January 2012. So it means that the asset will be used for the entire of 2012. The asset will be used for the entire of 2013. Is that also? The entire of 2013, the asset will be used. The asset will be used for the entire of 2014. Is that also? Then 2015, 1st January 2015 means that they have not started 2015 yet. 1st January, they have not started 2015 yet. So therefore, the asset was used for 3 years. The asset was used for what? 3 years. The asset was used for what? 3 years. The asset was used for 3 years. Is that also? That is so. So you say, as at 1st January 2015, so cost of the asset is what? 80 million. Then depreciation will be 80 million. I'll just show you the working. So divided by 20 times 3 years, go to 12 million. So do the depreciation, subtract the depreciation, then you get what? The carrying value. What's the carrying value? 68 million. So the carrying value of the asset. Are you okay? So what have we done? We've not done anything. All this was for you to explain, for you to understand how we got the depreciation. Okay, I've made you understand that in order for us to get the carrying value, we have to know the value of the asset as at 1st January. And this is the value of the asset. This is the value of the asset as at 1st January. How did we get this? I made you understand that in order for you to get carrying value, okay, in order for you to get carrying value, you have to subtract what? The total depreciation from the time you started using the asset. We started using the asset from 1st January. We started using the asset from what? 1st January 2012. So the entire of 2012, we used the asset. Entire of 2013, we used the asset. Entire of 2014, we used the asset. Is that also? So total depreciation will what? Will be 80 million divided by 20 times 3. I mean, when you divide this by this, you get 4,000 or 4 million. 4 million times 3, you get 12 million. It's the same thing. Are you okay? So now that you have understood, so we started using all this is not necessary, just for you to understand it. So it's as simple as this, okay? As at 1st January 2015, this is what you get. This is the value of the assets, and we call it the carrying value of the assets. Are you okay? So therefore, we now find the revaluation surplus. What is revaluation surplus? Revaluation surplus is, okay, this is the value of the assets as at 1st January. We want to change the value in our books. Are you okay? We went to the market to ask, and they told us the asset is now costing 95 million. The asset that we are having 68 million in our books now, that same asset now is now costing 95 million in the market. Hey, the asset that we are having 68, no, same asset is costing 95, meaning that we have undervalued the asset in our books. Meaning we have undervalued the asset in our books. So we have to increase the value in our books. So how much do you have to add to the 68 in order for you to get 95? And that is what we call the revaluation surplus, okay? It means that you are having 68 million in your books, but the value is actually 95. So it means that you have to increase it from 68 to 95, okay? So that is what we call the revaluation surplus. So revaluation surplus will be equal to revalued amount. Revalued amount. What is the revalued amount? 95 million. And we have the what? The carrying value, right? The carrying value, which is what? 68 million. So when you subtract, you get difference of 727. So this is the revaluation surplus. Are you okay? So this is the revaluation what? Surplus. So this revaluation surplus, what it means is that, you see, in our books, we have 68,000 or 68 million in our books. But it's not supposed to be so. You're not supposed to have 68 million in our books. We are rather supposed to have 95 million. So this 27 million, we are supposed to go and add it to the cost in our books. That the value in our book will be equal to the 95 million. Then we know that we have revalued it to the market price. In the market, the asset is costing 95, but in our books, it's costing 68. How do we get a 68? It is the cost that we bought it, less any accumulated depreciation. Less any accumulated depreciation. Depreciation from the time we use the asset to current date. So that is what? 12 million. So when you subtract 12 million from this, you get 68 million. The 68 million is the what? Is the carrying value started before we did the what? The revaluation. So after revaluation, we got a surplus of 27,000 or 27 million. This 27 million, we are supposed to add it to the cost of the assets in our books. So you add this to the cost in your books so that you get what? 95 million. Are you okay? So as at 1st January 2015, when the revaluation was done, as at 1st January, when the revaluation was done, total PPE will now be 95 million. Why? Because it is 68. Why? How did you get it? It is 68 million plus 27 million. These two, when you add it, that's how come we get this. You see this same amount, this same revaluation surplus. It is a surplus, it is a revaluation surplus to us, right? So therefore, it is a gain. So this amount, you have to send it to statement of comprehensive income. This revaluation surplus has to be sent to statement of comprehensive income. That is, if you are doing corporate reporting or financial reporting, you have to send this 27 million to statement of comprehensive income. That's the 27 million, the gain. Are you okay? You have to send the gain to statement of comprehensive income. You have to send it there on the statement of financial performance. But then after you send it there, this same amount, after you send it to statement of comprehensive income, this same amount, you have to send it to equity. Under equity, we have something called revaluation surplus or revaluation reserve. Revaluation surplus or revaluation reserve. Okay. So when you send it to statement of comprehensive income, then you transfer it to statement of what? Revaluation surplus or revaluation reserve. It's the same thing. Are you okay? That is, if you're doing financial reporting or corporate reporting. So how did we get the revaluation surplus? It's not difficult. The new price in the market minus the cost in our book. The new price in the market, the price that is being sold in the market, minus the cost we have in our book. So how much is the net book value in our book or the carrying value? It's 68 million. How did we get this? You should know it. You, the accountant, you should know it. Because the question will always give you how much we bought the asset in a long time ago. So we bought the asset 2012. So you have to know, okay, the cost we bought in 2012 minus depreciation for 2012, minus depreciation for 2013, minus depreciation for 2014, before you come and get what? The book value. And now I'm here depreciation. Who's the minus simple, I say. This simple depreciation is the same as you writing the cost we bought in 2012. We bought it in January 2012, so it means the entire of 2012, the entire of 2013. So the depreciation for 2012 will be 4 million. Depreciation for 2013 will be another 4 million. Then 2014 to be another 4 million. When you subtract, I guess it's 8 million. We don't have time to come and do this childish thing. Okay, when you get 68 million, this is the cost as at 2015. We don't have time to come and do childish thing. You are chartered accountant. What is this trade depreciation? The 80 million divided by the 20 years times 3. I've shown you how we got this thing. I've even showed you how we got the depreciation. My name now, and I've cleaned it. Are you okay? But if you are working, this is how you do the working. I've showed you all this. So minus. So this is the cost in our book. So far the cost from the book value. So from the revalued amount, which is 95 million, you get a surplus. This 27,000 or 27 million is the surplus. So this surplus, no, you send it to revaluation gain in the statement of financial position. Are you okay? In the statement of financial position, and that same amount you send it to statement of comprehensive income. Please, you get it? Assuming they ask you to prepare the financial statement for 1st January 2015. Assuming they ask you to prepare the financial statement for 1st January 2015, this would have been the end. Wow. So once a PP, you know, it's now 95 million. The asset is now costing 95 million. It is equal to the market price. Because when I went to the market, it is now 95 million. So I have now changed it from 68 million to now 95 million by adding the surplus to the cost in my book. So this 27 million, I added it to the cost that I already have in my book. And I'm being away. All this is happening on 1st January. 1st January, the day that I did the revaluation. So the day that I did revaluation, I got revaluation surplus. And now the value of my PPE now moved from 68 million to 95 million. I know I'm repeating it over and over again. I have a reason for doing that. I know why I'm repeating, because I want it to stick in your head. This is not for exam purpose. This is the confusion part. What we are here, PPE will not be anything to you. Remember, this is 1st January. We don't prepare financial statement on 1st January. 1st January simply tells you that it's the beginning of a new year. So the beginning of a new year, that is where I did the revaluation. So I'll prepare. So the question says that what? Calculate the amount to be shown in the financial statement of S&D as at 31st December 2015. December 2015, but the revaluation was done on 1st January. The revaluation was done on 1st January. Can you see that? So therefore, I have to depreciate the assets for 2015. So 2015, I have to depreciate the assets. So depreciation after revaluation. You have to depreciate the assets because you did the revaluation on 1st January 2015. And you are supposed to prepare financial statement for 31st December 2015. So you have to depreciate the assets. You have to depreciate the asset for 2015 because you have to use the asset for 2015. That also. But the only thing is that then now the value of the asset is 95,000 or 95 million. It's no more 68 million. The value of the asset as of 1st January that you account to depreciate is 95 million. So you account to depreciate 95 million. So depreciation will be for only that year will be equal to 95 million divided by, pay attention, after revaluation, you depreciate the asset by the remaining useful life. After revaluation, you have to depreciate the asset by the remaining useful life. You don't use the entire 20 years. 20 years, no. I bought the asset in 2012 and I said I'm going to use the asset for 20 years. You are just revaluing it. You are not changing in the useful life. You are just revaluing the asset. It's not the useful life you are revaluing. The useful life in there, it does not change. Are you okay? So when I started using it in 2012, the 20 years, no, I've used 1 year of it. 2013, I used another year. 2014, I used another year. 2015, how many years will remain? It will be 17 years. So remaining useful life. After depreciation, you have to use the remaining useful life to depreciate the assets. So this amount divided by 17, that's the remaining useful life. Is that also? So what do you get for depreciation? So depreciation will be 5588.24. This will be depreciation after revaluation. So after revaluation, now this is the amount that you are, this is the depreciation amount. Are you okay? You divide it by the remaining useful life after revaluation. Because, see, let me explain it to you. When I bought the asset first, I said, I will use the asset for 20 years. Then in the course of the year, I went to the market and realized that the value of the asset has changed. If the value of the asset has changed, it has not changed, or it will not change the number of years I said I will use it. I said I will use it for 20 years, and it is 20 years I'm going to use it. Already, how many years have I used it in the past? I've used it 3 years in the past already. So if the value have changed, then I'll continue from the number of years I used it, right? I've already used 3 years of it. So how many years remain? 17 years. So you divide it by 17. This will become your depreciation for the year. 2015, this will become your what? Your depreciation. Is that also good? So therefore, statement. So the question says that what? Calculate Mayu. I'm done. I'm done. So this is the value as at 2015. 2015, this was the value, 2015, 1st January. And I've used this portion of it. So 31st December, it will no more be 95 million. I've used, okay, I think I have to add, this will not be common. Please use a calculator to point this. I think this will be, punch this. 95 million by divided by 17. 95 million divided by 17. You get 2,558, 235, 23. I got this. Okay, this is the depreciation. Can you see that? Depreciation. So therefore, we say, question says, calculate the amount to be shown in the financial statement. So let's go. Statement of financial position. Extract. Statement of financial position. So statement of financial position extract. I'll have my PPE. So the PPE amount is 95 million. And I used it for the year. And the depreciation for the year is this. Is this. So you have 89411,764. So this will be the cost of the assets now. Okay, it was 95 million, but I've used it for 2015. Did the depreciation for 2015. You get this. Perfect. We proceed. Now we have revaluation. So under equity. Under equity and reserve. You have revaluation reserve. This one, I'm not teaching for exam purpose. That's why I'm explaining into details. If it is exams, I'll just show you some 2 steps where you continue. But I just want you to understand it. Anyhow the question comes, okay? So revaluation reserve, that's the revaluation with surplus. The revaluation surplus, I said you transfer. Are you okay? Perfect. Revaluation surplus. That is. Anyway, right. Now let's go to statement of financial. Statement of financial performance. Extract. You have depreciation. Depreciation for 2015. Only depreciation for 2015 that you have to what? You have to show, because that is the year under review. That is the year under review. Can you see that? Yes. So depreciation here is that also? Depreciation is an expense. Let me put it in brackets. Can you see that? Then listen, if you are doing financial reporting, if it is financial reporting, then you have other comprehensive income here. Other comprehensive income, then you write revaluation surplus there. If it is financial reporting, if it is not financial reporting, but it is PSA, you don't bring other comprehensive income. If it is PSA, no other comprehensive income. Please you get it? So that is that. So somebody is asking, say practically, and at what point do you realize it? Please, you only realize the revaluation surplus if you sell the assets, or you can decide to transfer it over time. Are you okay? You can decide to transfer it over time. So you can decide to transfer it from the revaluation reserve to retained earning. That is the amount, the difference between the old depreciation and the new depreciation. That amount, you have to be subtracting from revaluation reserve into retained earning. Okay, so you can decide to realize it over time, or you can decide to realize it when you sell the assets. Are you okay? That is to the extreme. Okay, not really. Yeah. So if you want to, that one, you do it in class. Perfect. So please, this is revaluation. This is how revaluation is done. This is how revaluation is done. It's not difficult. The concept is that you have to know the carrying value of the assets. After you know the carrying value of the assets, then you have to know the new revalued amount. Subtract the carrying value from the revalued amount. You get revaluation surplus. That is where it ends. So the revaluation amount, like I said, to go to the balance sheet as revaluation surplus. So there is it. Balance sheet. Any revaluation surplus. Any revaluation surplus is same as revaluation reserve. Okay. The same thing. Okay, this is the revalued amount. Revalue. This same amount, we added it to the cost of the asset. That is why the cost of the asset, we wrote 95 million. That is assuming the revaluation was done at the end of the year. But because the revaluation was done at the beginning of the year, it means that we have to still continue to depreciate the revalued amount. You have to depreciate the revalued amount for 2015. So it will be this divided by this. Right? When depreciating, it is the number of years you are going to use the asset divided by the number of years you are going to use the asset. You have to divide it by the revalued amount. But remember, after revaluation, you only divide it, or you only divide the revalued amount by the remaining useful life. Keyword, remaining useful life. Remaining useful life. Remaining. Remember, the total number of years they said they will use the asset is 20 years. They have already used 3 years out of it. So we are now left with 17. Remaining useful life is 17. Hey, somebody's writing on my screen. Are you okay? Remaining useful life. So that is what I divided it by. Perfect. So I got my depreciation. So this is my depreciation for the year. But you see, you see, I divided this one. I divided it because the revaluation was done on 1st January. And the question said I should prepare financial statement as at 31st December 2015. But the revaluation was done on 1st January. So therefore, January to December is 1 year. That is why I divided it to get depreciation for 1 year. So this depreciation, subtract it from the 95 million. Assuming the revaluation was done on 31st December, depreciation. So okay. So the second question is saying that what on 1st January 2013, S&D Professional Institute on 1st January 2013, S&D Professional Institute purchased an item of PPE for 12 million. So 1st January 2013. Okay, that is when they purchased it. Purchase an item for what? How much? 12 million. That is the cost of the asset as at 1st January 2013. Good. S&D Professional Institute uses the revaluation model to revalue its non-current asset. The asset has zero residual value. The asset has zero residual value and it's been depreciated over its useful life of 10 years. The asset is being depreciated over 10 years. At 31st December 2014, the asset was revalued to 40 million. You see, 31st December 2014. So they bought the asset for what? In 1st January 2013. And at 31st December 2014, how many years? So solution. You have to find the carrying value. You have to first of all, 1, find the carrying value always, and 2, find the revaluation surplus. So this is the 2 things you are supposed to do. Then you are done with the work. So let's first of all find the carrying value as at the day they did the revaluation. They did the revaluation on 31st December. So you write as at 31st December 2014. Okay. what was the value in our books? So as at 31st December, the day they did the revaluation, what was the value of the asset? This 12 million was how much they bought it in 2013, 1st January. But as at 31st December, how much was the value? So the value will be equal to the cost that we bought it as at that day, which is 12 million. In fact, please, let me work everything in 3 zeros. Are you okay? I'm working everything in 3 zeros. Are you okay? Yes, let me work everything in 3 zeros. So I'm working everything in 3 zeros so that I'll not be writing plenty. Good. So cost is 12,000. Instead of saying 12 million, 12,000. Are you okay? Perfect. Now, you and I know that you have to calculate what? Depreciation. Because in order for you to calculate the carrying value, it is good. Is carrying value is the cost minus the total depreciation from the day I started using the asset. So depreciation for 2013, depreciation for 2014. How many years? Oh, this one is only 2 years. So it means I'll use it from 2013, January to December, then January to December of 2014, 31st December 2014. So exactly 2 years. So depreciation will be equal to the cost divided by 10 years times 2. Is that also? Or it is the cost, which is 12 divided by 10. The saying 1200. Is that also how many years times 2? So times 2. It's the same thing. So you get 2400. Is that also? That is so. So when you subtract, how much do you get? You get 9600. So this becomes the carrying value of the assets. So the day we did the revaluation, this was my book value. This was the value of the assets. This was the actual value of the asset. On the day we did the revaluation, and not 12 million. 12 million, when I bought it in 2013, that was when it was 12 million. But I have used it for 2 years. So the value will reduce by the depreciated amount. So even 9,600. This is the value of the asset. That's at the day we did the revaluation. So therefore, when we did the revaluation, did I get revaluation surplus or loss? So let me see, revaluation. Revaluated, okay, let me see, revaluation surplus or loss. I told you, these are the two things you have to do. Find the carrying value, the revaluation surplus or loss. So is it revaluation surplus or revaluation loss? So the revalued amount. What is the revalued amount? How much? They say 14 million. Revalued amount is 14 million because of the 3 zeros have raised the power. So therefore, I'll work without the 3 zeros. Are you okay? Then the carrying value, the value in my books. You see, it is costing 9. In my books, no, it is 9,600. But outside, no, it is 14,000. Can you see that? It means that I have a lower amount in my book. So I'll make a gain, revaluation gain. I'll make a revaluation gain of what? 4,400. This is a revaluation gain. Now, this revaluation gain, we have to add it to the cost of my assets so as at this time, my PPE, as at the day I did the revaluation, my PPE will now be costing 40 million. How did I get a 40 million? It is the 9,600 I already have plus this one. Again, I have to add it to my PPE so that I get my total PPE in my books to be what? 14,000. This same PPE, I have to send it to revaluation reserve or revaluation surplus. So let me just make it revaluation surplus since that is what we all know. I have to send to revaluation surplus in the what? Statement of financial position in the balance sheet. Are you okay? If I'm doing PA, then I will not send this amount to other comprehensive income because there's not like other comprehensive income. If it is not PSA, but rather cost reporting or financial reporting, then I have to send it towards other comprehensive income. PSA, there's nothing like that. Are you okay? So this amount, add it to the PPE, then send it to revaluation surplus. Okay, good, I'm done. Now pay attention. Pay attention here. You see, the question says that what? Calculate the amount to be shown in the financial statement. That's at the year ended December 2014. What about for me? When did we do the revaluation? We did the revaluation on 31st December 2014. And they say you should show it in the books as at 31st December 2014. Meaning, after we did the revaluation, we didn't use the asset again. after we did the revaluation, we didn't use the asset because they said we should show it in our books as at 31st December 2014. We didn't use the asset again after revaluation. So therefore, if I didn't use the asset again, then it means I'm done. I will not revalue I will not depreciate the revalued amount. I will not depreciate it because after I revalued it, I didn't use it. But assuming the question says that prepare the financial statement for 31st December 2015. If you say 2015 there, you see, I revalued it in 2014. Then it means that I have to what? Depreciate it one more again. But over here, I will not depreciate it again because it says I should prepare the financial statement for 31st December 2014. And it was on 31st December 2014 that I did the revaluation. So the day I did the revaluation, I need not to depreciate it because I've not used it. After the revaluation, I've not used it. Are you okay? So good. So therefore, let's do the financial statement extract. I mean, this is not part. No. This is how the working is supposed to. Just this and this, maybe. Okay. Just I wanted you to understand that now this is the amount in my book. Then the surplus now add it to it. You understand it? So that you can now reinstate the value of your asset to the market value asset. Are you okay? So now the total asset will now become 14,000. Okay, no more 9,600 because this 9,600 now, it means that you have undervalued it. So you have to raise it to the market value by adding the surplus to it. And now I can have the same catch up. That's why I did what I did. Are you okay? Good. So now let's prepare the statement of financial position extract. So I have my PP. PP, it was supposed to be 9,600, right? Plus this amount, the revaluation surplus. Plus the revaluation surplus. How much are you getting? You'll be getting the 14,000. Put the 3 zeros on top. Are you okay? Then go to revaluation surplus. You'll be brought to equity. So it is under equity, you write revaluation surplus of what? 4400. Good. So let's go. Statement of financial performance. Statement of financial performance. You have depreciation. Depreciation for the year. So for the year, what was the depreciation for 1 year? Depreciation for 1 year was 1,200. After the revaluation, I've not depreciated it. After revaluation, I've not depreciated it. So I'll just use this depreciation, which is 1,200. This is 2 years, 2 year depreciation. So one of it is 1,200. Is that also? 12,000 divided by 10, you get 1,200. That's depreciation.
Yes.
Depreciation is 200. Do the depreciation, 1,200. Usually, I like to put it in bracket because it's an expense. Are you okay? This equity is credit. I have to put it in brackets. But if I put it in brackets, some of you will cry. So instead, let me write equity on top. Why not 2,000? Listen, this 2,400 is for how many years, my boss?
For 2 years.
So 1 year will be what, please?
1,200.
Exactly. That's for 1,200. Now, if it is financial reporting, then I write statement of comprehensive income. If it's financial reporting, then I write revaluation surplus of 4,400. But of course, it's not that one. Okay. If it is PSA, you don't bring this. If it's PSA, you don't bring it. If it is PSA, you don't bring it. Now, sometimes the question can tell you that the company transfers. Pay attention. The company transfers revaluation surplus to retain earning. The question can tell you that the company transfers the revaluation surplus to retain earning. It's not difficult. You don't worry. We'll talk about that one in class. But if the question doesn't say it, you are done. If the question doesn't say it, look at this. Please look at this. He says that what? See, S&D Professional Institute does not make an annual transfer to retain profits. You see, it does not make an annual transfer. So here, it does not make. So you do it like this. But the question tells you that it makes an annual transfer. There's something small you do. Okay. But then that one, we'll take it later. Okay. If I introduce that one, some of you will get confused. Small. Let's build on it small. Okay, good. We are done. We are done. You see how simple and how fast you afford the second one, because we have now understood it, right? Good. So we are done with that one.
Sir.
Yes, please.
Please, I understood 2,400. I understand
Perfect.
how we got the 2,400 by adding the 2 years. But my worry is that the depreciation being charged 1,000, only 1,200.
Perfect.
I think.
Let me tell you why.
I was thinking maybe you add the 2 years to it.
No,
maybe
depreciation is charged for only 1 year. Depreciation is charged for only 1 year. Please, two of us. So the 2,400 is for 2013 and 2014. Please, two of us.
True.
So here is 1,200. That's what I said. It's annoying. It's children that do it that way. So if I want to know the cost of the asset as at 2014, then it means that I have to write the 12,000 minus depreciation for 1 year. That's 2013 depreciation. So I'll do that. Then I'll subtract. Then I'll subtract 2014 depreciation, 1,200. Then I'll subtract that one too before I get a 9,600. That one is for children. Okay, this is how we got it. What will you tell me? Madam, what is the depreciation for 2014 alone? Oh,
Steve.
The depreciation for 2014 alone. Yes, I can hear you. Can you hear me?
Yes, I'm thinking that he wants to know why it is only 1,200, and you are not to show the accumulated depreciation because you are preparing for the books for only 2014. So it is that year depreciation that you have to show as an expense.
Okay.
So you cannot bring the accumulated.
Okay. I was thinking that.
Assuming that the question says that we'll prepare 2015 financial statements, extract. 2015. If it says 2015, then the revaluation occurred in 2014. Is that also? The revaluation occurred in 2014. So when the revaluation occurred in 2014, we got revaluation surplus of what? 4,400. Okay. Now, the PP for 2014, 31st December, became 14,000. Is that also? So now this is the value of the assets. As at 2014 ended. As at 2014, 31st December 2014, this is the new value of the assets. So therefore, if you want to prepare a financial statement for 2015, then we have to calculate depreciation for 2015. We have to calculate depreciation for 2015. Okay, so to calculate depreciation, we have depreciation will be equal to the cost. What is the cost? 14,000. Now, when they bought the asset, they said we were going to use the asset for 10 years. They said we were going to use the asset for how many years? 10 years. My question to you is, how many years have they used it before the revaluation? How many years did they use it?
2 years.
They used it for 2 years. So therefore, like I keep telling you, depreciation after revaluation will be the revalued amount divided by the remaining useful life. The revalued amount divided by what? The remaining useful life. So this is the revalued amount. The new revalued amount divided by the remaining useful life, which is 8 years. So what are we getting? Please, what did you get? 1750. Is that correct? Oh, calculator.
Yeah, correct. 1750.
Perfect. 1750. So this is the depreciated amount. This is the depreciation for the year. Okay. So therefore, we are done. So 2015 financial statement will be like statement of financial position. Statement of financial position will be PPE. Okay, PPE will be equal to the cost. 14, this is the cost of the asset. Also, minus the depreciation. What do you get? 12,250. Can you see that? Yes. So for 2015, there's no more revaluation surplus. Okay, we didn't get new revaluation surplus. Are you okay? But remember, the old revaluation surplus will still be in the books. This, you see, statement of financial position, that one is not annually. It is forever going concern. So the revaluation surplus will still be in our books. The revaluation surplus from 2014 will still be in our books. It's not a new one, no. The old one, no, is still in our books. How much did you get, Seth? 4,400, right? Yes.
Yeah,
So the 4,400 will still be in our books. It's not a new one, no. The old one is still in our books. Okay, this is because we are paying financial statements for 2014 and 2015. Then statement of financial performance. P&L. We have depreciation for the year. Depreciation for the year.
12 to 50. Yeah, 17750. Yeah.
Perfect. Yeah. It's as simple as that. So the only thing you have to find out, okay, is how much is the carrying value? How much is the asset worth? As at the day they were doing the revaluation. The day they were doing the revaluation, how much was the value of the assets? After you get the value, subtract it from the revalued amount, you get valuation surplus. The valuation surplus becomes statement of financial position item. It will go to statement of financial position. If you are doing financial reporting there, it will go to other comprehensive income. Then, if you ask yourself, when was the revaluation done? Was the revaluation done at the end of the year? If it was done at the end of the year, then you will not revalue it if it was done at the end of the year. So this question, the revaluation was done at the end of the year. So I did not revalue the amount. I carried the entire revalued amount straight into the statement of financial position because it was done at the end of the year. But if the revaluation was done before the end of the year, then it means that after you have revalued it, you have to depreciate it, like the first question. After we did the revaluation and we got this amount, as at 1st January, we did the revaluation, we got this amount. Then we went ahead to depreciate it again because we didn't revalue at the end of the year. We revalued at the beginning of the year. So for that year, I will use the revalued assets. So you have to you understand it? Remember, the remaining useful life. So when you want to depreciate any revalued amount, you use the remaining useful life. Remember, if you want to depreciate any revalued amount, you use the remaining useful life. Okay. So that is that. So we have another question here. Okay, so my question to you is that what if the revaluation was a revaluation loss and not a revaluation gain? What if the revaluation, we got a revaluation loss and not a revaluation gain? When you did the revaluation, assuming we got a revaluation loss. When you do the revaluation, assuming we got a revaluation loss, please, how do you treat it? If you get a revaluation loss, please don't send it to the balance sheet. If you get a revaluation loss, do not send it to the balance sheet. When you get a revaluation loss, send it straight to the P&L, statement of financial performance, as an impairment. So when you send it to the P&L, you write under it impairment. What you see here, don't send it to the balance sheet. Don't send it to the statement of financial position. Unless in the previous year, there was a revaluation gain. That is already in the books. Assuming, you see this question, you see we have revaluation gain here of 27,000. Can you see that? We have revaluation gain of 4,400. We have revaluation surplus of 4,400. Let's say 2016, there was another revaluation. Assuming in 2016, there was another revaluation, and the revaluation, the asset revalued to 7,000. The asset that we are having in our books as 12,250, it was revalued to 7,000. The asset was revalued to only 7,000. Not just say we are going to make a loss of how much? We are going to make a loss of how much, please? 5,250. So that loss of 5,250, no, the principle says that when you make a loss and there's already a revaluation surplus in your balance sheet, that loss, no, so let's say there was I'm reframing the question. So we are continuing this question. We say that on 1st January 2016, there was a revaluation again. 1st January 2016, there was a revaluation. On 1st January 2016, there was a revaluation, and the asset was revalued to 7,000. The asset was revalued to what? 7,000. Now, if the asset is revalued to 7,000, then what it means is that we have to reduce this amount to 7,000. You have to reduce the 12,250 in our books to 7,000. You get it? So we are going to make a loss of 5,250. So this loss of 5,250, no, do you know what you do? This amount, no, send it straight to the balance sheet and go and subtract it from the gain. Who said we have a gain of 4,400? Go and subtract the 5,250 from the 4,400. You still will left with 1,250 as a loss. So that loss must send it to the P&L account as impairment. But here, when you make a loss, when you do revaluation and you end up with a loss, when you do revaluation and you end up with a loss, that revaluation loss, no, send it to the statement of financial performance as what? Impairment. Send a statement of financial performance as impairment. But keyword is if there is already a gain in your balance sheet. You can't have a gain in your balance sheet and have revaluation loss. No, if you already have a gain, go and reduce the gain by the loss. Do you get it? Send the loss to the revaluation and I'm going to subtract this loss.
In that case,
I will get.
In that case, the gains that you get already in the previous year, you have to reduce it in your balance sheet.
Surplus again, your surplus will become zero.
Okay.
In that case, your surplus will become zero. Then you'll be left with extra loss.
Yes.
Hello, sir.
That
please, hello, sir.
Financial performance as impairment. That's what the principle. Let's take that part of the question. Anyway, so there's it. See, they said the revaluation decrease or revaluation loss. Please pay attention.
Hello.
The revaluation decrease. Please, do you want to ask a question?
Yes, please. For my next, hello.
It seems your network is not that good. Reposition yourself.
Please, let me ask a question.
Sir, please, I want to find out that when your revaluation surplus is more than the loss, would that difference be sent to P&L as impairment, or that one you not take it to P&L again? For instance, your surplus.
Repeat. When your surplus is more than the loss, is that the case?
Yeah.
Yes. So that one, when you deduct it, you not take the difference to. So there will not be difference.
No.
Okay.
That difference, you leave it on the balance sheet. So already the balance sheet, is supposed to be where the surplus will be. Is that not the case?
And this time your deficit is, let's say, the surplus is 10,000, and your deficit is 5,000.
Please, I'm coming. I want to make it very practical. So you are saying that the revaluation surplus that you already have in your books,
10,000.
The revaluation surplus that you already have in your books is what?
10,000.
So revaluation surplus is 10,000. Okay.
And the loss that you got for the second time is 5,000.
So the loss you got is 5,000.
Yes.
Madam, assuming there's no revaluation surplus, the 5,000, where are you supposed to send it?
As impairment.
As impairment
PNL
in a statement of financial performance. Perfect. In your P&L. That's so good. Okay, good. Now continue.
So if you have the loss as 5,000, he said we should deduct it and place the remaining balance at the P&L account. But in this case, your surplus is more than your loss.
So therefore, your revaluation surplus
will still be 5,000 and
5,000. Perfect. Not just say it has reduced your what? You have reduced your surplus from 10,000 to 5,000. So now your surplus will now become 5,000. Well, you don't move it.
So yeah, you not go and record anything as a impairment again.
No, you're not. Because the surplus is more than the deficit.
Okay.
Good. But assuming your revaluation surplus is 10,000, like you said, and you got revaluation loss in the second time. You got revaluation loss. The second time you were doing revaluation, you got revaluation loss of, let's say, 17,000. 17,000 revaluation loss. So it means that the 17,000 is supposed to come and subtract from this. And you see that you get extra loss of 7,000. Can you see that? This extra loss, no, send it to the P&L as impairment. But that's as here.
Oh, yes.
Perfect. So let's do a typical example. We have a typical example here. On 1st April 2018, S&D, the value of S&D's limited leasehold property was 100,000. You see, the property was 100,000. Perfect. Let's continue. With a remaining useful life of 20 years. The company's policy is to revalue its property at the end of each year. At 31st March 2019, the property was revalued at 86,000. Can you see that? So the balance on the revaluation surplus, the balance on the revaluation surplus on 1st April 2018 was 20,000. That is, there's a balance on revaluation surplus. That is already in the balance sheet. It's 20,000, which relates entirely to the leasehold property. So the surplus relates to the leasehold property. Solution. So quickly, this one is not difficult. Solution. Now, its accounting year will be from April to March. Is that also? April to March. So if this is 2018, this is 2019. That's one full year. 1 year. It's not January to December. This is April to. So they're saying that on 1st April 2018, the fair value of S&D leasehold property was 100 million with a remaining useful life of 20 years. The company's policy is to revalue its assets at the end of each year. 31st March 2019, that's 1 year. From April 2018 to 31st March 2019 is 1 year. Can you see that? 1 full year. Okay, that's their business period. As at 31st December, the property was revalued to 86,000. Can you see that? So you have to find the carrying value for that 1 year. So solution, what will be the depreciation? The depreciation, like I said, is not difficult. Always the cost of the asset divided by 20 years. How much are we getting? We are getting 5,000. Is it 5,050?
5,000.
Yes. So did the depreciation for every year. Can you see that?
Hello.
How many
Hello,
years?
sir.
How many years did they use the assets? Please, I'm coming. They use the asset 1 year. Also,
1 year.
they use the asset 1 year. So therefore, let's find the carrying value. So the carrying value will be equal to the cost, which is 100,000. Hey, mute yourself. Mute yourself if I beat you. Mute yourself. So depreciation is 5,000. Okay, here depreciation. I've already done the calculation here, so no need for me to do into brackets. 100 divided by 20. But you still, let me do it. 100 million divided by 20. That's the depreciation. 1 year. This one is times 1 because it's only 1 year. 5,000. So the carrying value is 95. 95,000. So on this day, this is when they did the what? This is where they did the revaluation. Is that also? So they did the revaluation on 31st March 2019. That is 1 year. So the revaluation Revaluation, the revaluation will always give you either surplus or loss.
Loss.
So let's see. So let's see. Revalued amount is 86. Leave the value in the market. Oh. Now, what is the carrying value? The carrying value is 95.
95.
Meaning you are making a loss of how much?
14,000.
Loss of 14,000. Okay, that's so brilliant. Loss of 14,000. Yeah, are you sure? Are you sure it's 14? Use your calculator.
Okay.
Confirm.
9,000. 9,000.
9,000. 9,000, sorry.
Abwa. Okay, good. 9,000.
9,000, yeah.
Okay, good. 9,000. So 9,000. 9,000. Perfect. So we are done. Are you okay? So did the evaluation loss. Are you okay? Now, if the question goes ahead and tells us that we should prepare a financial statement for 2010, that means that the asset will be used again. Here, they didn't tell us that asset was used. The day they did the evaluation, that's the day they said we should prepare the financial statement. So say, 1, prepare extract of S&D Limited financial statement for the year ended 31st March 2019. 31st March 2019. So we are preparing the financial statement. So here will be statement of financial performance. So here, depreciation for the year. What is depreciation for the year? 5,000. Maybe suspense. So I'll put it in brackets. Next one, statement of financial position. Now, so PP, look at something here. PP will be now the cost in the market, 86,000. This is the cost of the assets now, even though it was 95. But the value of the market is 86. Let me show you how we got the 96. Let me show you how we got the 86. The 86 is the 95 that we have in our books minus the loss of 9,000. That's how I got the 86.
We do agree that.
Then we go retain earning. No, revaluation surplus. Revaluation surplus or loss. So the book say, the question say that what? There's a revaluation surplus of what? 20,000 already in our books. So let's know, you see this loss, we are supposed to send this loss to P&L as impairment. We are supposed to send the loss to statement of financial performance as impairment. 9,000, you send it there as impairment, full stop. But because, let me put this in brackets, but because there's already a gain, we have to send the loss to go and reduce the gain. You can't be having a gain and be lost. That means you can't have money in the bank and you'll be owing loan. No, you have to use the money in the bank to pay the loan. Okay, so if you have a loss, subtract the loss from the gain. You get what, please? Is it 11,000? Or what? What do you get?
11,000.
11,000.
Yeah, 11,000.
Perfect. I'm done. Awesome. Who's the revaluation surplus needed? Balance sheet, no, if the item is there, you'll be carrying it forward, you get it. So this 20,000 is revaluation gain or revaluation surplus. But because there's a loss of 9,000, go and subtract the loss from the gain. Assuming there's no surplus in our books, then 9,000 would have gone to statement of financial performance as impairment. That's all what I'm saying. Are you okay?
Sir,
now look at the next question. Please, I'm coming.
Sir, please.
Can I come? Please ask a question. Yes, please ask a question.
On the phase of the calculation, can we do it? Is it appropriate that we do with the impairment losses is sent or treated at on the face of financial performance? Then the difference, the profit, the additional profit that we got, we'll bring it in the financial position with the calculation that you have made it here. We will not bring it. So, we'll do it. I hope I'm making a point.
Yes, you are making a point. Here, what you just said, let me stress on something. I think I'm focusing so much on the PSA side. If you are doing FR, listen, if you are doing FR, what would the loss we got to know? You have to send it to other comprehensive income as revaluation loss.
Yes.
If you are doing FI, you still have to send it through the statement of financial performance as you see other comprehensive income. Go and put it there as revaluation loss.
Okay.
That is if there's a gain. If there's a gain, you have to send the loss to the other comprehensive income.
Okay.
If there's a revaluation surplus, then this loss, you have to go and put it under other comprehensive income. Then you send it to revaluation loss like you have done. Then you send it here. But before you bring it here and go and put it here under comprehensive income. Standing in your balance sheet, then send it to the statement of financial performance as impairment. Are you okay? That one, they don't go and put it under comprehensive income. If there's no revaluation loss in the balance sheet. Are you okay? Amount here. Don't send to the statement of financial performance. Don't send to the statement of financial performance at all if it is PSA, like I've done. So when you get your loss of this amount is supposed to go to impairment on the statement of financial performance. But because there's a revaluation gain or revaluation surplus, don't send to the statement of financial performance. Send it straight to the balance sheet. But the ideal place is supposed to be the statement of financial performance as what? As impairment. Good. Go to the next question. State how the accounting would be different if the opening revaluation surplus did not exist. State how the accounting would be different if the opening revaluation surplus did not exist. Who would like to answer?
I think
if the opening revaluation surplus
does not exist. So we carry the revaluation loss, the loss that we get as an impairment. We put it at the financial performance.
Perfect. That's all. You send this to a statement of financial performance as what? As impairment. If revaluation surplus does not exist in the balance sheet. But if it exists, then you have to go and subtract it from there. Don't send it there. But if it is FR or corporate reporting, then you have to send to your other comprehensive income as revaluation loss. Thank you very much. You are very good. I like that. So please, I will leave you to go and try this one as assignment. Try this. Everything you've done, this is how the question will come. Okay. Kindly try this as assignment. Are you okay? Try this as assignment. Then you have subsequent expenditure, which I expect you to go and read. When you read, you will understand. Once again, this is S&D Professional Institute. Okay. All what you are doing is not for exams purpose. It's for practical sake. So, but if it is, I'm preparing you for exams, there are certain things I will not teach you. Okay. There are certain things I will not even go there at all. I just go straight to the point. But over here, I didn't even go into details enough. I just don't want to confuse you so much. But then everything I taught is something you have to understand at your level. It's something you have to understand because you're a chartered accountant. Some of you are chartered accountants. Some of you too, you are learning for examination. If you are learning for examination, it is good because I've opened your mind as to the reasons why certain things exist, why we do certain things certain way. You have to understand it so that you never forget. Are you okay? Perfect. So this brings us to the end. God willing, tomorrow. Please, I'm coming. God willing, tomorrow, you'll be meeting Sir Desmond at 7 o'clock p.m. You have class, God willing, 7 o'clock p.m. in the evening, and he will be taking you through impairment. That is our financial reporting and corporate reporting facilitator. Okay. Like I said, this CPD is a very good thing. Okay. It's going to expose you to a lot of things. Are you okay? So please, you meet Sir Desmond, who will be teaching you financial reporting. He who teaches financial reporting and corporate reporting.
The new cost that we are incurring, or it's going to be an expenses as maintaining the building.
Perfect. I like your question. So his question is basically, after the initial cost, if there are subsequent expenditure on the same assets, should we treat it as repairs and maintenance, or we should treat it as cost to the building? Is that a question?
Yes, please. Exactly. That's the question.
So therefore, the note is so detailed in such a way that I have a topic called subsequent expenditure. Subsequent expenditure. After the asset has been built, and you incur subsequent expenditures. Those expenditures, no, do you add it to the cost of the asset, or you treat it as an expenditure? Please, in some instances, you have to add it to the cost of the asset. In some instances, you have to expense it. In some instances, you have to treat the cost as an asset on its own. In some instances, you have to treat the cost of the expenditure, no, as an asset on its own. That maintenance work you did, no, you have to treat it as an asset and depreciate it. In some instances, you have to expense it. In some instances, you have to add it to the cost. So let's go. Subsequent expenditure. I didn't want to teach it, but since you've asked, let me quickly take you through. Subsequent expenditure. Let's go. So subsequent expenditure on PPE should only be capitalized. Subsequent expenditure, okay, after the cost has been after you have recognized the cost of the asset, the expenditure that you incur after the cost, no, you can only capitalize it. That is to say, you can only add the cost, the expenditure cost to the cost of the asset if the following occurs. One, if the cost is to enhance the economic benefit of the asset. That is to say, if the cost you are incurring on the asset is to enhance the useful life of the asset. You understand it? So the question you have to ask yourself is that now you have incurred a cost of 50,000 on the building. Maybe the building cracked, and you have incurred 50,000 on the building. So the 50,000 you incurred as expenditure on the building, is that 50,000, is that cost you have incurred going to expand the useful life of the assets? Is it going to expand the useful life of the assets? If yes, then you have to add it to the cost of the assets.
Okay.
Don't expense it if it's going to expand the useful life of the assets.
Okay.
Two, if it's going to increase the what? The productivity of the assets. So sometimes you have a machine that you don't service. And somebody got the idea that, no, let's service this machine. Then you spent a huge amount of money to service the machine. The machine was producing 5 tanks a week. After you serviced it, the machine started producing 20 tanks a week. Can you see that the cost you incurred on the expenditure in the cost of it has increased the productivity of the assets? If that's been the case, then you have to capitalize it. That cost, don't expense it, capitalize it. Why? Because it has enhanced the economic benefit of the assets. The economic benefits can either be increasing the useful life or what? Increasing the productivity of the asset. My boss, are you okay?
Yes, please.
So you are the chartered accountant of your company. If such an expenditure occurs, you should decide as to whether you treat it as an expenditure or you capitalize it. Whatever decision you make should be based on this enhancement of the economic benefit. Ask yourself, is it going to increase the useful life or is it going to increase the productivity? If none of the two is taken, expense it. Two, major inspections. Major inspections.
Okay.
Major inspections like aeroplanes. Please, their inspections are expensive. Elegonta, you know Elegonta? Major inspection. There are some assets if you buy, you have to compulsory, it's part of the contract. You have to what? Inspect, you have to do major inspection. Major inspection in the sense that you have to do more or less like overhaul. Overhaul inspection, like more or less like, who say aeroplane, for instance. Major inspections are constant. Maybe every 3 years, you have to do major inspection. You go and employ those who created the asset. Let them come and inspect it and ensure that everything is okay. You see, whether the thing is sport or not, they have to open to check. They are doing major inspection. Your car, they are saying every 3 months, you have to send it to the mechanic. Okay. Let's assume that you send it to the mechanic to the extent that they are going to open the engine to make sure that the engine is okay. They are going to open the bonnet. They are going to check under the vehicle. Major inspection, major. If the expenditure is a major inspection, basically, if it is in a contract, then you have to capitalize it.
Okay.
You understand it?
Yes.
Now, if it involves replacement of a key component, or if the expenditure involves the replacement of a key component, or replacement of a component, then you have to capitalize that one too. And sometimes, no, the replacement of the component, no, you have to what? Depreciate it separately.
Okay.
Yes. Sometimes you have to depreciate it, especially claim parts. Okay. When you do financial reporting, Sir Desmond will take you into details. Are you okay?
Okay.
We'll take you into details. Are you okay? Very well. Or when he comes tomorrow, ask him those things.
Can
Very well.
inspection be same as maintenance?
Maintenance, key maintenance.
I'm
Yes,
saying
you
that
are correct.
inspection be the same as maintenance when you're talking
Yes,
about
please. Yes,
okay.
please. It can be, in fact, it is the same. Okay, general one. This one is general one. You know what I'm saying? General overhaul. You understand it? Whether the thing is fault or not, they are going to check and inspect and ensure that everything is okay. This one's
You have
no,
to
the value involved is very huge. The value involved is very huge. And there are certain special assets, like the aeroplane. Okay, whether I like it or not, you don't wait for it to spoil before. Because if you don't take care, the engine will spoil in the sky, and you are going to lose a lot of people. So this maintenance and these inspections, they are very key. And these are what we call the subsequent expenditure that you should capitalize. So my boss, in your company, if any of these things occur, use the point one. The point one is usually what applies to all companies. Okay, if the expenditure, and sometimes to the value of the expenditure. If the value is so huge, please capitalize it. I mean, this basic thing there, that's what if the value is so huge, I'll
I was
capitalize
about
it.
to say that one. I was
If the value is so
about to
huge,
ask that one.
capitalize it.
Can you use
If
the value?
the value, yes. If the value is so huge, capitalize it. But if auditors come, you have to explain to them. Auditors can call you and say that the mere fact that the value is huge does not necessarily mean that it's going to increase the economic benefit of the asset. The auditors can ask you that if the auditor is a chartered accountant. That's why it's good to be a chartered accountant. Okay, good. We are done. We are done. We are done. God bless you. We are going to meet, God willing, tomorrow, 7:00 p.m. Same time. Okay. Thank you so much. If you have any questions, you can ask. Other than that, this is us to the end of today's class and the end of PP. Please try this question. Okay. If you also watch recorded video, you can call me or DM me to send you. My number is below the description. Madam, besides say something.
I'm saying that based on the subsequent expenditure on PP, when you are capitalizing, you have to add the cost of it.
Repeat what you said, please.
Saying that based on what you just said now, that if the items are huge, you have to capitalize it. So we are going to add the cost of the asset. Okay.
Oh,
That's good. Yes. You have to add it to the cost.
Already at it.
Yeah. Okay. As if you have bought a new asset. Add it to the already existing PP. You get it? So if it is building and the value of the building is 20,000 and the expenditure is, let's say, 5,000, the building will now move from 20 to 25,000. Madam, what you
Yeah. Yes.
That's how it means that add it to the cost that you already have.
So on the face of the balance sheet, how will you write it? So just write it maybe 5,000 plus 10,000 straight and just write it there like that.
Well, and see how facilitator you enjoy. So please, if anybody has a question,